Good morning, everyone. We will give 2 to 3 minutes for the others to join in. Okay, all right. We'll give another 2 minutes since this is our first class. And as you can see, the instructions for the class, please come on time. So if we start at 8:30, everyone is expected to, join the session by 8:30. For the ease of the class, everyone will be on mute. So I'll be the only person who will be doing all the talking. Whenever I'm teaching or whenever I'm asking question to the panelist, I would request everyone to put their responses in the chat window. And as and when I teach the content, you will definitely have questions. So please write down your questions or make a note of your questions somewhere. Do not post those questions when I am explaining the content. Please post those questions in the last 15 minutes of the session. The reason is that when I'm teaching, I am not focusing on the chat window in the Zoom. All right. So there is a possibility that I might miss the question that you're asking. And also, at times, it becomes difficult for the faculties to focus on the content, explaining the content, and then looking at the questions. All right. So these are the few instructions for the class. I'll give 1 more minute and then we will get started with today's session. All right. So let's get started with today's session. Yes, someone has posted a question that she is new to US taxation. This subject is an advanced version of taxation. That is correct. So tax compliance and planning. This is an advanced version of US taxation. So if you have not attended my regulation sessions, it will be difficult for you to interpret the subject. I'll try to give as much explanation as I can, but you have to have a basic understanding of US taxation. Now, when I took my orientation 2 weeks back, most of the people responded in the chat window that they have not attended the regulations. And this is the first time they are going to do this subject. So I'm going to make it as, I'm going to give a lot of examples and decode as much as possible. But remember that if you are looking to make a career in US taxation, this subject will make more sense if you attend the regulations first, because there where you are taught the basics, and then this is a little bit of advanced version because more complex topics are taken here. So what I'm going to do today is that I already discussed what are the content that we are going to cover over the period of next 2 months. Next 1.5 months or 2 months, we'll see how the classes go and how the participants are able to interpret the concepts, understand the concepts. So today we are going to start with the easiest topic that we have in this syllabus. So if you recollect from the orientation session, I mentioned that the easiest topic that we have in this content is chapter 4. Okay, so we will start with chapter 4. Now, chapter 4 is an independent topic. When I say independent topic, means that it does not reference any other topic in the last three, in the first 1 to 3 chapters of your TCP. So this is something that you can study independently. We would come across certain tax terminologies and concepts which you may not be familiar with. So the first 2-3 classes, I am going to go really slow. So people who have tax compliance background, please don't get impatient. If you feel that the pace of the class is very slow, please understand that there are many people in the panelist who are very new to US taxation. So it is important for me to decode those terminologies for them. So the first 2 or 3 classes, I'm going to go really slow and take up as many questions as I can from the panelist. And once we have a fair understanding of some of the terminologies that we are going to cover in chapter 4, we will speed up our pace. Now, there's one more thing that I'm going to do is that as we progress towards the syllabus, I am going to ask you to look up certain concepts online by yourself, because it is imperative that you understand those concepts and terminologies before you come and attend the TCP class. Because remember that TCP is a advanced version of US taxation. So as a homework, I would want you to go back and read a little bit about the basics before you come back and do the difficult part or the complex part of US taxation. But for today's, the first 2 sessions, don't bother, because we have picked up a very easy topic, and I'll try to explain it as slowly as possible. All right. So setting the tone for the class, today we will cover 2 modules from this content. So we are going to do property transactions. And in today's class, we are going to do the non-taxable dispositions and dispositions of trade or business use property. I'm sharing my screen. Let me know if it's visible to everyone. Put your responses in the chat window. Okay. Thank you so much. And remember that this is an online session. Please don't sleep. Please be awake, and please participate as much as you can. The only way I know that you are listening to me and participating if you put your responses in the chat window whenever I'm asking you a question. All right. So we will cover the non-taxable disposition and disposition of trade and business use property. And we will cover the related party transaction in our next class. Manisha is having issues with hearing me. Is anyone else having any issues? Are you able to hear me clear? Okay, Manisha, maybe you check your system, okay? Because everyone else is able to hear me clear and loud. All right, so now let's get started with our first topic, which is our non-taxable dispositions. Now remember that unless the law specifically calls out or tells you that this transaction is non-taxable, everything else is a taxable transaction. Now, when I say everything else is a taxable transaction, that means that everything that you do, you sell, you earn, you get commission, all that money through different sources, you have to pay taxes on it. Unless the law specifically tells you that this transaction, this gain, this earning is non-taxable for you. So under non-taxable dispositions, what we are going to learn is, we are going to learn certain transactions where the gain is either deferred or the gain is excluded. Okay. Now I'm using 2 terminologies here, which we will be using again in the future chapters as well. So one is gain being deferred. Deferred means that you do not recognize or you do not pay taxes on that gain today, but you do it in the future. Okay. And the other terminology that I'm using is that you exclude the gain. That means you do not pay taxes on the gain that you have reaped out of that transactions. Okay. Now, there are very limited transactions in which either the gain will be excluded or it will be deferred. Just give me 1 minute. I'll be back. All right, I'm back. So as I was mentioning that there are very few transactions in which either the gain or the loss will be deferred. That means you will not recognize the gain or the loss immediately, or they will be excluded. That means you will not have to pay taxes on it. All right. Now, this is a general formula that they have given here as to how do you calculate the gain or loss on a disposition of a property. So, amount realized. Realized means that again we will come across two tax terminologies as we go through this chapter. One is realization event and one is recognition event. Okay. Realization is when you are transferring the ownership, when there is an economic exchange. Recognition is when you actually pay taxes on the gain and or you recognize the loss on a transaction. So realization is when there is an economic exchange. Recognition is when you account for that gain or loss on your tax event. These two terminologies will be heavily used when we come across one of the disposition that is like kind exchange dispositions. All right. So amount realized means the money that you are going to get from a sale of or an exchange of a property. So money received, that means the cash that you're getting. Cancellation of debt. Cancellation of debt means you owe someone money and that person has forgiven you the debt. Or the person who's buying the property is taking over the loan that is associated with that property or the mortgage that is there on the property, right? So that's also if you taken a debt and someone is forgiving that debt for you, that is an income for you. Okay, so cancellation of debt, fair market value of the property that you receive. So in a transaction, not only you receive cash, but there is a possibility that you may get another property in exchange. Okay, so whatever the fair market of the property that you're receiving in exchange, that's also a part of your amount realized minus any selling expenses. Now, how would you know what is your gain or your loss unless you know what is the basis of your property? Now, basis, what do we mean by basis here? Basis is again a tax terminology, and this is something that we should all know. So today, let's say I buy an iPhone. The iPhone has costed me $1,000. What is my basis in that iPhone that I have bought? My purchase price becomes my basis in the property. Okay. I'm asking very, very simple questions and I don't see a response on the chat window. I don't know what will happen if I'm going to ask you complex questions. All right. Now, let's understand what is adjusted basis. Basis, we know whatever our initial investment in the asset is our basis. But what is adjusted basis? So let's say that I buy a house and I construct a second floor on the house. Okay. The initial value of the house was $100,000. And after the construction of the second floor, I spent another $50,000. So what is my adjusted basis of the house now? People, what is my adjusted basis? So $100,000 was my initial investment in the house. I made a capital expenditure which has adjusted the basis from $100,000 to $150,000. Likewise, your property can also depreciate, right? So let's say that I invest in a depreciating property, which is a car. All right. Now, car is for, let's say, $100,000. And I anticipate that it is going to run for another 10 years. So at the end of the first year, if I take a straight line depreciation based on the life of the car, I will take $1,000 of depreciation. So beginning the second year, what will be my adjusted basis of the car? I bought the car for $100,000 and I've taken a depreciation of, let's say, $10,000. At the end of year one or at the beginning of year two, my adjusted basis in the car is going to be $90,000. So again, as I mentioned, that I'm going to go really slow and explain you each and every word that is there on the content, because the terminologies that we are going to learn here will be repeated in the different sections of your TCP. All right. So basis is your initial investment and adjusted basis is the adjustment to the property, which can be an appreciation and which can also be a depreciation. Now, there are certain ways to acquire a property. You can purchase the property. That means you invest your own money in getting that property. That property can be gifted to you, or you can inherit the property. Now, depending upon how you get the property, the basis would differ. Now, let's say if I go and buy the iPhone myself and I pay $1,000, I know that the basis of my iPhone is $1,000 because I purchased it myself. Let's say my father gives me his iPhone. He used it for 6 months and gave it to me. Okay. So how am I acquiring this iPhone? It is a gift to me from my father. So whatever my father basis is in the iPhone will become my basis. So let's say if my father paid $700 for the iPhone, that will be my basis when this iPhone is gifted to me. Now, when it comes to gift, there is also an exception. We are not going to that exception because that is not required for our examination purposes. So for the ease of understanding, the gift will have the rollover basis. That means whoever is gifting you, whatever price they paid for the property, that is going to be your basis in the property. There is also a way to inherit. When do you inherit? Obviously, when the person who owned the property passes away and you are the beneficiary. Okay. So whenever you inherit a property, it is on the fair market value. All right. So if I am inheriting something after my parents pass away, I will consider the fair market value of the property. So that is going to be my basis. I know the basis. I know what amount I have realized. Now I will be in a position to recognize my gain or loss, right? So that's a very basic formula. Now we are going to cover the transactions where either the gain will be excluded or the losses will be, deferred, or the gains will be deferred. Okay. So the first transaction that we are going to do is homeowners exclusion. Now remember that in the United States, there are different entities paying different taxes. Individual taxation is different. Entity transaction is different. So a corporation will have different tax rules. A partnership is going to have a different tax rule. An S corporation is going to have a different tax rule, and an individual is going to have a different tax rule. So the first transaction that we are going to do today, the homeowners exclusion, is a transaction that is specific to individual taxation only. This transaction, this benefit is only given to individuals. It does not apply to entity taxation. That means this benefit is not given to corporation, partnerships as corporations. These are only meant for individuals. So under homeowners exclusion, what we are going to learn is that whenever an individual taxpayer sells their primary resident and if they satisfy certain criteria. Now, what are those criteria? I'm also going to explain you that. But if they satisfy those criteria, they are allowed to exclude certain amount of gain. So that means they do not pay taxes on that gain. Now remember, the homeowners exclusion is only available on gain transaction. That means you are selling the property more than the basis that you have in the property. Okay? If there is a loss, then you are allowed to take that loss. Personal property, sometimes it is difficult to take the loss, but you're allowed to take the loss. But homeowners exclusion is on the exclusion of the gain. Now, in the United States, when you do individual taxation, there are different filing statuses. Now, these filing statuses will be explained in depth when you attend your regulation classes. But because we have to understand this concept, I'm going to briefly tell you what are those filing statuses are. So there is single. So someone who's single, he will have a filing status of single. Someone who's married, they can file as married filing jointly. That means husband and wife together can file just one form. If they are married, but they choose to file separately, then the filing status for them is married filing separately. If someone gets, widow, then there is a filing status of filing widow or widower. And then there is one more filing status, which is called the head of household. Head of household means that you don't qualify under married filing jointly. And you are single, but you are, supporting your parents or someone, which gives you a better tax slab. Now, depending upon the filing statuses that we have, there are different tax slabs. So that means a single person will have a different tax slab, married filing jointly will have a different tax slab, head of household will have a different tax slab. Now, why it is important for me to tell you the different filing statuses? The reason is that when we do the homeowners exclusion section, we need to know what is the filing status of the individual, because basis that we would know how much of gain we will be able to exclude. So if you are single, then the exclusion amount is $250,000. If you're single and if you're head of household. If you are married filing jointly, your exclusion amount is doubled. That means now you can exclude up to $500,000. Okay. So you see, depending upon the filing status, your gain exclusion amount changes. And it is important that we remember this number. I'll tell you where you have to remember numbers, and I'll tell you where it is not needed to remember numbers, because those numbers are adjusted for inflation, and they will 99%, they'll give those information in the question when they're asked. So now we know that there are different filing status and the gain exclusion amount will depend upon the filing status. Now let's understand, when do you get this benefit? What criteria you will have to satisfy? Okay. So there are two criteria that you have to satisfy. One, that you should own the property at least for 2 years from the 5 years period ending on the date of the sale. And you should use the property at least for 2 years from the 5 years period ending at the date of sale. So that means you should own the property for 2 years and you should use the property for 2 years. Now the usage provision and the ownership provision, the period may not be same. Okay. So let's say that in January, 1st January 2020, I rented a place. Okay. I rented the place for a year. I fell in love with that place and I offered the landlord that I'll buy the apartment from him or her. After 1 year, I purchased the property. So in January 1, 2021, I was owning the property, right? In January 1, 2022, I got an opportunity to work in US and or let's say I was in US, I got an opportunity to work in a different state. So I moved to a different state in the year 2022. I owned the property till December 2023. And then on 1st January 2024, I sold the property. Okay. So in my example, am I satisfying both the requirements of owning the property for 2 years and using the property for 2 years? The answer to that is yes. Why? Because the first year I have lived in that property, though it was a rental property. So I used the property, though I was not owning it. Remember, I told you that the usage period and the ownership period may not be same. Okay. So I used the property for 2020 and 2021. Did I satisfy the ownership requirement? Did I own the property for 2 years? The answer to that is yes. I purchased the property on 1st January 2021 and I sold it on 1st January 2024, right? So I have satisfied both the requirements. I have owned the property for 2 years and I have used the property for 2 years. Maybe the period for the usage and the ownership was not same. That's why they are saying that you should own the property and use the property during the 5 years period ending on the date of the sale. So from the sale date, you have to look back 5 years and determine whether you satisfy the 2 years of usage of property and the 2 years of ownership of property. So if you satisfy these two requirements, depending upon your filing status, you will be able to exclude gain. So you see, this section here talks about how much gain can be excluded. So if you are married filing jointly, that means husband and wife is filing one tax return and you are a qualifying widow or widower, surviving spouses, then you will get an exclusion amount of $500,000. If you are a filing status single, or you are married filing separately, or you are head of household, you will get an exclusion amount of $250,000. All right. So when you are reading this topic, I want you to remember few things. And these notes are not there, but I'll try to post it for you. Okay. So whenever we do homeowners exclusion, remember the filing status, because depending on that, you will know how much of gain needs to be excluded. Requirements to qualify for the exclusion. So that means you have to meet both the use test and the ownership test. For married filing jointly, there is a separate provision which I will cover shortly. So for married filing jointly, any one person can own the property, but both the husband and the wife should satisfy the use test. Okay. Exclusion is available for a person who becomes widow or widower if they sell the property within 2 years of the if when their partner passes away. We have a hardship provision and we have non-qualified use of property. This is again, I'm going to explain you, but these are the 5-6 points that you have to remember when you are studying the homeowners exclusion. All right. So I'll go back to the content now. So let's look at this example here. A taxpayer with a single filing status. So they have mentioned the filing status for you. Purchased a home and lived in the home as her personal residence for 1 year. After 1 year, she was transferred by her employer to work in new city for the next 2 years. During this 2 years period, she continued to own the house but rented it to a tenant. After 2 years in the new city, she returned to live in the house for 1 year prior to selling it. So in this example, has the taxpayer met both the ownership test and the use test? So you have to look for 5 years from the sale of the property, look prior 5 years. So if you see, she has owned the property for 4 years and she has used the property in the first year and she has used the property in the 4th year. So she is satisfying both the requirements here. So if you see the solution, it says that taxpayer meets both the ownership test and the use test because she owned and used the house for 2 years or more during the 5-year period prior to the sale. So from the sale date, you have to see what was the activity prior to the 5 years from the date of the sale. Even though the use of the property was not in consecutive years, okay, because she used the property in the first year and then she used the property in the 4th year. The taxpayer is eligible for the exclusion. However, the eligible exclusion amount may be limited because there is non-qualified use of property. Now, what is non-qualified use of property? I will explain you in a bit. All right. Now, the second thing that we have to remember, as I mentioned, that when you are filing as married filing jointly, your exclusion amount is double. That means instead of your gain that you can exclude up to $250,000, now you can exclude up to $500,000. Now, not necessarily both husband and wife will own the property. In most cases, the man is the one who is owning the assets. Okay. At least that's how it is in India. And sometimes it is possible that the wife is owning the property and the husband is staying in the property, right? So what they are saying is for married taxpayer, it is not mandate for both the taxpayers to own the property. As long as one taxpayer is owning the property, but they both use the property for 2 years, they will be eligible for the exclusion of $500,000. Okay. Both have to use the property for 2 years. So let's look at this example. After owning and using his house as a principal resident for 3 years, a taxpayer marries and his spouse moves into the home. So here the husband is owning the property and he's now getting married. After 1 year of marriage, the taxpayer and his spouse decide that they need more space and sell the house. So now in this scenario, has the wife satisfied the use requirement? She has not, right? Because she stayed in the property only for a year. In this case, ownership requirement is okay, but because both the husband and the wife, like the wife has not satisfied the use criteria, the exclusion amount will only be $250,000. They will not get the entire $500,000. Okay. If this is an important point, please make a note somewhere that if someone becomes widow or a widower, they are eligible to get a exclusion amount of $500,000 if they sell the house 2 years after the date of the descendant's death. So within 2 years, if you execute the property, then you are eligible for an exclusion of $500,000. Now, there is no age limit to get the exclusion, and there is no requirement for you to purchase another property to get the exclusion. And every 2 years, you can use this exclusion. Because remember, why do I say every 2 years? Because you will have to use the property as your primary residence, and you have to satisfy both the ownership requirement and the use requirement. So at a minimum, you have to own that property for 2 years and use that property for 2 years. So every 2 years, you can use the exclusion and save up to $250,000 or $500,000, depending upon whatever your filing status is. Okay. Now, under this provision, we have two more things that we need to keep in mind. One is a hardship provision, and the other one is the non-qualified use of property. I'll repeat myself. In this topic, there are two more things which are very, very important that we need to remember. One is the hardship provision. The second is the non-qualified use of property. Now, what is hardship provision? Hardship provision is that ideally you are supposed to satisfy both the requirements before you can get the benefits of exclusion of the gain. However, if there is a unforeseeable circumstances, if there is something that is beyond your control and you have to sell the property, then in that case, the government will give you some benefit, but not all benefit. Okay. The hardship can be that because of work, you have to travel to another city and you have to sell the house, or there could be some health issues that you may have been diagnosed with some very deadly disease. For that, you have to sell the house. It could be for any other circumstances which is listed as per government, which will create hardship for you, for which you have to sell your house. In those circumstances, if you have not met the requirement to use the property or the ownership of the property for 2 years, the government will still give you certain benefits. Now, how would we determine how much benefit we will get? Will be decided upon your ownership of the property, right? So what is the minimum period that you have to own the property in order to get the full exclusion of $250,000 or $500,000? What is the minimum? Two years, right? Now, let's say that if someone is staying in that property only for 6 months, okay, and then that person is diagnosed with cancer, and now there's a hardship, that person has to sell the house. So the qualified usage is supposed to be 2 years, but you have owned the property and lived in that property only for 6 months. So in this case, what the government will do is they'll say that you prorate your exclusion amount on the number of months you have owned the property. So let's say this person who was diagnosed with cancer was a single taxpayer. Okay. Now for a single taxpayer, what is the exclusion amount? For single head of household, the exclusion amount is $250,000. So my denominator here is 2 years, right? Because that's the minimum period I need to own the property. So they are saying that now you prorate the exclusion based on your ownership. So how many months did I own the house? Only 6 months, right? So now that becomes my numerator. So 6 months is my numerator, 24 months is my denominator. What will be my exclusion amount if I prorate it by 6 months? Right? So my exclusion amount is now 62,500. Excellent people who are responding in the chat window. Thank you so much. Right? So now on the sale of the property, I will be able to exclude up to a gain of 62,500. Okay. Now let's say that the property that I purchased was for $50,000 and I sold the property for $65,000. So my purchase price is 50, my sale price is 65. What is my realized gain in this transaction? My realized gain in this transaction is $15,000. How much of this gain I am going to recognize? So remember that we have prorated the exclusion amount to 62,500. That means up to that much of gain I can exclude. But if you see, my actual gain in the transaction is only $15,000. So in this case, I will be able to exclude the entire 15,000 of gain. Okay. So what you're doing in the hardship provision is you are prorating the exclusion amount. I'll repeat myself. You are prorating the exclusion amount based on the ownership of the property. Okay. So we'll do one example here and then I'll explain you the non-qualified use of the property. So 1 year after purchasing her home and living it in as a principal residence, a single taxpayer was diagnosed with non-treatable cancer. The taxpayer sold her home to move in with her daughter, who was caring for her. The taxpayer sold the home for a gain of $150,000. First of all, does this fall under a hardship provision? It does, right? It does falls under a hardship provision. Okay. So next question that we are going to see is, what is the filing status of the taxpayer? So the filing status of the taxpayer here, he is a single taxpayer. So if he is a single taxpayer, what is the exclusion amount that we have for the single taxpayer? It is $250,000. Now, the third thing that we are going to see is that how much is the period in, the ownership period that the person has met. Because that is what we are going to use as a numerator to prorate the exclusion amount. So you're supposed to own the property for at least 2 years. But how long did the person own the property in this example? The person owned the property only for 1 year or 12 months. So 12 months is my numerator 24 months is my denominator. What is my exclusion amount? It will be half of it, right? So $125,000. Now, my gain on the transaction is $150,000. So how much of this gain can I exclude? I can exclude up to $125,000, but I will still have to go ahead and pay taxes on the remaining $25,000. Okay. In this same example, if we keep everything as is, okay, and we change the filing status of the taxpayer to married filing jointly, and they both satisfy the use requirement, and husband is satisfying the ownership requirement. Then what first question is, if I change the filing status to married filing jointly, what will be the exclusion amount that will be available to them? And will there be any gain or loss recognition or not? So $500,000 is the exclusion amount, but will they get the entire exclusion? The husband is only owning the property for 1 year. So then what will be their exclusion amount? It will be half of $500,000, which will be $250,000. If they have a gain of $150,000, will there be any gain recognition in the transaction? There will be no gain recognition in the transaction because the exclusion amount is much bigger than the actual gain that they have reaped out of this transaction. So remember that whenever you read a question which is coming from the hardship provision or from this topic, identifying the filing status of the taxpayer is very important because based on that, your calculation is going to change. Now, the next thing that we are going to learn is the non-qualified use provision. So remember that this benefit is given to you because you are selling your primary residence where you intend to use it for personal purposes. Okay, because in the very beginning of my lecture, I mentioned that this is a provision that is only available to individuals. This is not available to business entities. But you now rent your property. And you could rent it for any reasons, right? You moved to a different state for work, or you were not using the property, you went abroad for work, or you had bought another property which you were staying. So when you are not using the property, or I would say when you're renting the property, it becomes like a business, right? Yes or no? You bought the house to stay there, but now you're using it as an activity to make revenue out of it. So in that case, the government says, or the Internal Revenue Service says, Internal Revenue Service is the body which governs the US taxation in United States. So the IRS now says that, see, we provided this provision to you because it was a provision for individuals for their primary residence. But if you're going to use the property for non-qualified use, which could be renting the property, then in that case, I am going to reduce your gain, or I would rather exclude, for the period you have used the property for non-qualified purposes, I am going to reduce the gain and not going to give you any benefit out of it. Okay. So whatever the period of non-qualified usage is, we will determine that by the ownership of the property, and then that gain will be excluded. So that means you will not get benefit of the gain for which you have used the property for non-qualified purposes. Now, one very important point that you will have to make a note is that when we did the hardship provision, we prorated the exclusion amount. When we are doing the non-qualified use provision, we are prorating the gain amount. I'll repeat myself that when we did the hardship provision, we prorated the exclusion amount. When we are doing the non-qualified use provision, we are prorating the gain amount. That means on certain gains, you will have to go ahead and pay taxes. All right. So let's look at this example here. A taxpayer with a single filing status purchased a home and lived in that home as her principal residence for 1 year. After 1 year, she was transferred by her employer to work in a new city for the next 2 years. During this 2 years period, she continued to own the house but rented it to a tenant. After 2 years in the new city, she returned to live in the house for 1 year prior to selling it for a gain of $50,000. The taxpayer meets both the ownership and the use test because she owned and used the property for 2 years or more during the 5-year period prior to sale and qualifies for a maximum exclusion of $250,000. But what is the period for which the property was rented? Of the 4 years that she has owned the property, what is the period for which the property was rented? The property was rented for 2 years. That means those 2 years are non-qualified use of property. Okay. So what did I mention? That here you are going to prorate your gain. So my gain on the transaction was $50,000. So if I have to prorate my gain, my numerator is going to be my non-qualified use of property and my denominator is going to be my ownership in the property. So I owned the property for 4 years and 2 years was my non-qualified use of property. 1 second. So in this example, if you see, I had owned the property for 4 years and there was 2 years of non-qualified use of property. So my numerator here is 2 years and my denominator here is 4 years. So that means 50% of my gain will be eligible for exclusion and 50% of my gain I will have to pay taxes because the property was used for non-qualified purposes, right? So of the $50,000 of gain, $25,000 would be my gain that will be excluded and $25,000 will be the gain on which I have to pay taxes. Now, in the same example, if the non-qualified use of property was for 1 year, then what will be your gain that will be excluded and what will be your gain that you will have to recognize and pay taxes on it? If let's say the rental of the property was only for 1 year. So there are two questions. If the non-qualified use of property is only 1 year, what gain will be excluded and what gain will be taxable? Okay, I see some responses. Please be mindful that excluded means that you don't pay taxes on it and taxable means that you pay taxes on it. Okay. So those are some great responses. Thank you so much. So if we just change the non-qualified use of property to 1 year, then in that case, 1 year is our denominator and 4 years is our numerator, which changes the percentage to 25%. So that means of the $50,000, 25% will be non-qualified use gain, which is 12,500. So 12,500 is something that I will pick up as gain and pay taxes on it. And the remaining 37,500 will be excluded and I will not have to pay taxes on it. So what is the major difference between the non-qualified use provision and the hardship provision? Under the hardship provision, you were prorating the exclusion amount. Under the non-qualified use provision, you are prorating the gain amount. Please do not confuse yourself because the answer will go wrong. Okay. Here you are looking at the gain and prorating the gain. Here you are prorating the exclusion amount itself. So there is a possibility that the gain that you have may not be taxable at all under the hardship provision. And under the non-qualified use provision, you will always have certain portion of gain which will be taxable. Okay. Now, there's one more thing that we have to remember is that sometimes we will use the property and we will own the property and then, we will move somewhere else. But if we are not renting the property and the property is just lying there, there is no not disqualified use of property and the property is just lying there, then even though the property is lying there for a longer period, you will still be eligible for the exclusion. Okay. So if we look at this example here, a taxpayer purchased a home 7 years ago and lived in it for 4 years. Okay. The taxpayer then moved to a new city and placed the house for sale. The house sold after being empty for 3 years. Okay. So determine if any gain on the sale is excluded. So the house was not used for 3 years, before the sale of the house. So the gain should be available for exclusion up to a maximum amount as the taxpayer owned and used the house for 2 years in the 5 years prior to the sale. The time in which the house was empty and available for sale does not disqualify the gain from the exclusion treatment. So if you have not used the property for non-qualified purposes and it is just lying empty, you will still be eligible for the exclusion amount. Okay. We'll do few more questions on this, not questions, but I would say example on this concept. So let's look at example number 1. For the period 2000 to 2004, Albert owns a house in Michigan and a home in Florida. During each of these years, Albert lives in Michigan home for 7 months and in Florida home for 5 months. If Albert decides to sell one of the homes in 2005, only the Michigan home will qualify for the gain exclusion. Because he lives in Michigan for the majority of each year, this home is Albert's principal residence for 2000 to 2004. Okay, so in this example, what we are seeing is that the person is owning 2 places and he is using both the places. But the place where he is staying majority of the year, that place will be considered as a principal residence and he will get an exclusion amount on that property. Okay, let's look at the second question. Carmela, and in this question, be mindful of the dates. Carmela rented a house from Jan 1, 1993 to Jan 1, 1998. She purchased the home on Jan 1, 1998 and lived in it until Feb 1, 1998. On March 1, 2000, Carmela sold the home. So in this example, if you see, the use and the ownership period is not the same. But does she satisfy both the ownership requirement and the use requirement from the sale of the date? She does, right? During the 5 years period ending on the date of the sale. Okay. So the sale is happening on 1st March 2000. So from this date, you are going to look back 5 years. So from March 1, 1995 to March 1, 2020, in this 5 years, we are going to see whether she has met the use criteria and if she has met the ownership criteria. So she lived there from 1993 to January 1, 1998. So that means March 1, 1995, 1996, 1997, 1998. So she has definitely met the use criteria. Now let's look at the ownership criteria. She purchased the house on Jan 1, 1998 and she sold it on March 1, 2000. So she has ownership also, she has met the 2 years criteria because she owned the house in 1998, she owned the house in 1999, she owned the house till January 1st, 2020. So that is satisfying both the ownership period and the use period. So will she be eligible for the exclusion amount? Yes, no, maybe. She will be eligible for the exclusion amount, even though the use criteria and the ownership criteria is not during the same. Okay. Now let's look at this example. On January 1, 1999, Tom buys and begins to live in a home. On January 1, 2001, Tom marries Ursula and she moves into Tom's home. On January 1, 2002, 12 months after Ursula begins residing in the home, they sell the home because their employer transfers them to another state. Now, if you are selling your house because there is a change in the employment, does that fall under the hardship provision? Yes, no, maybe. Okay, so if we go back to the content here, let's see what does the hardship provision say. The hardship provision says that in case of change in the employment, health, or any other unforeseen circumstances, they are all eligible for hardship provision. Okay. So now, if I ask you the question again, is this falling under the hardship provision? The answer to that is yes. They are selling the house because there is a change in the employment and they have to go to another city to work. But if you see, here husband is meeting both the use requirement and the ownership requirement. But Ursula, the wife, is stayed in that property only for 1 year. And there is also a hardship provision. So what am I going to do? Is the government going to deny the entire exclusion of $250,000 which relates to Ursula? Or they are going to give some benefit because of the hardship? So out of the husband and wife, the husband is someone who is satisfying both the requirements, right? So husband is satisfying both the use requirement and the ownership requirement. Wife is only satisfying the use requirement for 1 year. So in this case, wife's exclusion will be prorated. Okay. So her husband exclusion amount is $250,000. Wife is $250,000. So for a total of $500,000. So husband, we have no issue. He's met both the requirements. But wife has only stayed in the property for 12 months. So in that case, we are going to prorate her exclusion by the number of months she has been residing in this place, that is being 12 months. So her exclusion amount will be only $125,000. So the combined exclusion amount for both husband and wife in this example will be $375,000. So what is the government trying to do here is they are not denying you the entire benefit. because of the hardship, they are giving you some additional benefits. Okay. So that is our homeowners exclusion provision. So that's one transaction where the gains are excluded and you don't pay taxes on it. Now, the second transaction that we are going to do is the involuntary conversions. Now, what do we mean by involuntary conversions? People, simple English. Not by choice. That's right. Can I have few more responses? No option, absolutely compulsory, not willfully, absolutely force, yes. Those are some of the words that do describe involuntary conversion. That means something that you are not doing by choice, something that you are not doing willfully, okay? So under involuntary conversions, and that could be because there is condemnation of the property, there is a destruction, there could be theft. So whenever there is an involuntary conversion, there could be two scenarios. One, there could be gain in the transaction and there could be loss in the transaction. So when we talk about involuntary conversions, if there is gain in the transaction, the gain is deferred, okay? But if there is loss in the transaction, then you recognize and report the loss and the transaction is done. So under involuntary conversion, the only thing that you are able to defer is gain. Losses you will recognize immediately and you will be done with the transaction. Now, involuntary conversions are applicable to individual taxpayers. Involuntary conversions are also applicable to the business entities. Okay. Now, how do we defer the gain? That means when you involuntarily dispose of your property and if there is gain, you may not have to pay taxes on that gain if you satisfy certain requirements. Now, what is that requirement? That either you replace the property into a similar property, or if you are getting cash, from the transaction, you are reinvesting all that cash to purchase a similar property. So as long as you are reinvesting the proceeds from the involuntary conversions, you are allowed to defer the gains and not pay taxes on that gain. Okay. So here the IRS is giving you more time to recognize, recognize the gain on the tax return and pay taxes on it, and not immediately when the involuntary conversion is happening. Okay. Now, conversion can be because of different reasons. And how long do you have to reinvest and buy a similar property would depend upon the transaction. So I'm going to give you that detail as well. So give me a second here. So if it is a personal use property, right, which you are using for personal purposes, and if it is an involuntary conversion, you will have to reinvest in a similar property within 2 years. If it is a business investment property, then you have to reinvest and purchase a similar property within 3 years of the condemnation of the property. And if it was your principal resident, which was destroyed in a federally declared disaster area, What is federally declared disaster area means? Like if there is, let's say, a natural cyclone, or something else, and the president says that this is a federally declared disaster, then in that case, you have 4 years to reinvest the money in a similar property. So let's say on your residence, you may have taken insurance. So if the residence was fully destroyed because of a cyclone or something, you have 4 years from that insurance proceeds to purchase a similar property. Okay. So what are we trying to do here? Remember that we started the topic by saying that we are looking at the transactions where either the gain is excluded or the gain is deferred or the losses are deferred. Okay. There is no point of excluding the loss. Nobody would want to do that, right? So in the first topic where we had the homeowners exclusion, we were excluding the gain. In the second topic, where we are talking about involuntary conversions, we are deferring the gains. That means you will not have to recognize the gain now, but you will have to do it in a later period in the future when you are selling the similar property which you have repurchased because either your property was condemned or your property was destroyed or, there's something else that happened. Okay. So in this provision, in this example, you are deferring the gains. How you are deferring the gains, we will understand in a moment. All right. So let's look at this example. Land owned by McIntyre had an adjusted basis of $30,000. What is adjusted basis? What do we mean by adjusted basis? Net book value. Okay. Cost adjusted. All right. Right. So this is basically, it's not selling price. Selling price is the amount realized. Adjusted basis is the tax basis of the property. Okay. This could be my cost to purchase the property. It was condemned by the state and McIntyre received similar property from the state to replace the condemned land. Determine the basis of the new property. Now, here in this example, they have not given the value of the land that McIntyre is receiving because of the condemnation of the property that he owned. Let's say the similar property that he receives from the state has a fair market value of $50,000. But what will be his basis in the new property? His basis in the new property will be same as his old basis in the property that was condemned, which is $30,000. If you look at the transaction, he owned a property where he invested $30,000, and because of this condemnation, he's getting a property which is worth $50,000. It is as good as selling your property for $50,000. So if this was not an involuntary transaction, if this was a voluntary transaction, McIntyre would have a gain of $20,000, right? Because he's giving a property which has a adjusted basis of $30,000 and he's getting a property which has a fair market value of $50,000. So in a voluntary transaction, he would have realized a gain of $20,000 and he would have recognized and reported that gain on the tax return. Because it's an involuntary transaction, the gain that we have on the property, which is $20,000, we are deferring it. And we are saying that the basis of the new property is $30,000. We know that the fair market value of the property that we are receiving is $50,000, but we are saying the basis that we have in the new property is only $30,000. Now, we are basically reducing the basis of the property from $50,000 to $30,000. So, we are reducing the basis and we are deferring the gains. When you reduce a basis of the property, what is the consequences when you eventually sell this new property in the future? Will you recognize a higher gain or you will recognize lesser gain? If your basis is less, you will pick up more gain and you will pay more taxes. Okay, so it's not that government is giving you any benefit here. The government is only delaying the process for you to recognize the gain and pay taxes on it eventually when you sell the new property. Okay, so under this concept, there are two important things that you need to keep in mind. The first important thing is that you will have to understand how much of the gain is realized in the transaction. Again, I'm using the word realized. I'm not saying recognized. Okay. So first you have to identify how much of the gain is realized in the transaction. Second, you have to identify how much of the gain will be deferred. So whatever you have reinvested, up to that amount will be deferred. If you keep some money in your pocket for your expenses or for party, then that money that you have kept will be taxable and you will have to pay taxes on it and recognize that portion of the gain. Okay. Now let's see this example. CRUD owned a building with an adjusted basis of $400,000. The state condemned it and awarded him $450,000. So in this transaction, what is the gain that is realized by CRUD? My property has a basis of 400. I am being awarded $450,000. So my gain, realization of the gain here is $50,000. CRUD bought a new building for $440,000. Okay. So of the $50,000 of gain, how much of the gain has he reinvested? Of the $50,000 of gain, how much of the gain has he reinvested? He's reinvested only $40,000 because he bought a new building which was worth $440,000. Okay. How much of the gain did he keep in his pocket? He kept a gain of $10,000. So now the gain that he has kept with him and he has not reinvested, what is going to happen to that? It will be taxable. Thank you so much. It will be taxable and he will have to pay taxes on it. Okay. Now, what is going to be CRUD's basis in the new building that he has purchased? He's purchased the building for $440,000. But what is the basis that we are going to record it in the books? What is going to be my tax basis for this property? It is going to be $400,000 because I am going to defer the $40,000 of gain, which I have reinvested in that property. So I am now bringing the property basis to $400,000. I'm lowering the basis. Okay. So let's say after 1 year, if CRUD sells the property for $430,000, how much gain or loss is he going to realize in this transaction? He will realize a gain of $30,000 and he's going to pay taxes on that $30,000. So you see, the building was actually for 440. After 1 year, the value reduced to 430. But because we had deferred the gain, we reduced the basis of the property. After 1 year, we will recognize that gain and will pay taxes on it. So understand that in this transaction, there are two things that is happening. One, you are deferring the gain by adjusting the basis of the property. And whenever there is a realization event that is happening in the future, you are picking up higher gains and paying taxes on it. So the only benefit that the government is providing you here is giving you more time to recognize the gain and pay taxes on it. Okay. Now in this example, if I say that CRUD adjusted basis and the building was $400,000 and the state condemned the building and awarded him $300,000. And CRUD bought a new building for $440,000. So if he had an adjusted basis of $400,000 and he was awarded only $300,000, is this a gain event or a loss event for him? Did he realize a gain or did he realize a loss? So he has a loss of $100,000. What did I mention about the losses and under involuntary conversion? I said that you do not defer the losses. You recognize the losses immediately and the transaction is done. So in this case, we will recognize a loss of $100,000. And then if CRED is purchasing a new building for $440,000, what is going to be the basis in the new building? The purchase of the new building now is a separate transaction altogether because I have already realized my loss. My transaction on that first property is closed. The purchase of the new property is a fresh transaction and I will record the building for the purchase price that I have for the building itself. Okay. Are we clear? Let's look at the loss recognition example here. Rangoli had a factory with a cost basis of $340,000 that was destroyed by a fire. The insurance company paid Rangoli $330,000. Rangoli used the money to buy a new plant for $500,000. Now, let's look at the transaction between the destroying of the property and the insurance proceeds. Is it a loss transaction or a gain transaction? The property was worth $340, but the insurance company paid only $330. So I have a loss of $10,000. So because I have a loss, I am going to recognize the loss immediately. And my purchase of the new plant of the $500,000 is going to be a separate transaction. So my basis in the new factory is going to be my purchase price of $500,000. Okay. Are we all clear? Now, I'll go back to this example and let's make it a bit tricky. Okay. We have same facts. Adjusted basis of the building was $400,000. The state condemned and awarded him $450,000. And here we will change the purchase price of the building. The purchase price of the building is $500,000. So CRUD bought a new building for $500,000. Now, if this number is changed, what will be the basis of the new property? And will there be any gain recognition in this transaction or not? So what will be the basis of the new property? And if there will be any gain recognition in this transaction. I am now changing the purchase price of the new building to $500,000. All right, excellent. For the people, those who have responded, there will be no gain recognition because he realized a gain of $50,000 and he has reinvested the entire gain of $50,000. But here, the purchase price of the new building is $500,000. So we will defer the $50,000 gain. That means we are going to reduce the basis of the new property by $50,000. So the basis of the new property from $500,000 will now be $450,000. Excellent, everyone. Thank you so much for your responses. So it's been 1.5 hours. I'm very bad at giving breaks, so you will have to ask me to give you a break. We have another 1 hour to go. So I will give you guys a 15 minutes break, and then we will be back by 14 minutes break. It's already 10:01. So let's all be back by 10:15, and then we'll continue with the remaining section. All right? Okay. Are we all back from the break? So are you guys having any other classes before my class? Any other CPA classes before my class? And how long is the FAR class? Wow, back-to-back classes, 6:30 to 8:30 and then 8:30 to 11. Are you guys able to retain the information? Are you guys comfortable with the classes and retain all the information for both the classes? So do you think it will make sense if I keep my class from 9 to 11? All right, so I'll speak to the admin and I will get the timing changed so that you guys have at least some breather between the class. So from the next session, we'll start our class from 9 a.m. Okay, and we'll try to have 2.5 hours class, but we'll see how it goes. I'm not very hell-bent on the timing. It is important that we understand the concept more than how much time we spend on the class. All right. So we have done 2 transactions till now. We've done the involuntary conversion and we have done the homeowners exclusion. Now the second transaction where there is no gain pickup, that means you exclude the gain, is a divorce property settlement. Now, whenever there is a divorce, there is a possibility that there could be a payment of alimony. Okay. If it is periodic payments, like every month, the husband or the wife is paying alimony, then in that case, the alimony can be taxable or non-taxable based on when the divorce decree was executed. But here we are talking about one-time lump sum payment. That means it is not a periodic payment, okay? If there is a one-time lump sum payment or there is a property that is being given in a divorce settlement, then you do not recognize any gain in that property. And whatever the husband's or the wife's purchasing price of the property becomes your basis in the property. And then when you eventually sell the property to a third party, that is when you are going to recognize the gain or loss. So here also you are deferring the gains. Okay. The next topic that we are going to do is the like kind exchange. Now, like kind exchange. What do we understand by that? Exchange means we are exchanging something for something. Like kind means that it has to be same, same kind of nature of the property. So like kind exchange, investment, real property. Now, when I gave my CPA examination in the year 2014, that time like kind exchange was for both real property and personal property. Do we all understand what is the meaning of a real property and what is the meaning of a personal property? Real property is your land, your building, your warehouses, and your personal property is your machinery, your desktop, your laptops, all right? All those are your personal property. So back in year 2013, when I was preparing for my CPA exam 13-14, like kind exchange was also applicable on the personal property. So you could exchange your laptop for another set of laptop, or you could exchange your desktops with another set of desktops. It was still an eligible like kind exchange. But now the provision has changed, the law has changed, and now we have like kind exchange only for real property. Real property means land, building, warehouses, those kind of property. All right. Now, in the like kind exchange provision, we are able to defer both gains and losses. Okay. I'll repeat myself. In the like kind exchange, we are able to defer both gains and losses. All right. So till now, we have done 3 transactions. Under homeowners exclusion, you were able to exclude gains, but there was nothing related to losses. Under involuntary conversions, you were able to defer the gains, but if you had a loss, you would recognize the loss immediately and close the transaction. Under divorce settlement property, we are again able to defer the gains. And in the like kind exchange transaction, we are able to defer both the gains and there is a deferral of losses. Okay. Now, qualifying property, we already know that it has to be a real property. So if you are getting a warehouse in exchange of a personal resident, though the property serves different purposes, the warehouse is to store the things and personal residence is to stay, though they don't serve the same purpose, but because they are real property, they are eligible for a like kind exchange. So they can still qualify for a like kind exchange and you may still be able to defer the gain or the losses. So let's look at example number 9. A taxpayer owned the building in which she ran her clothing boutique. When she retired, she sold the building and repurchased an apartment building which she held as an investment. Determine whether the taxpayer transaction qualifies as a like kind exchange or not. So because the taxpayer exchanged real property used in trade or business for another real property held for investment, the exchange should qualify for the non-recognition treatment available under the like kind exchange. All right. Property that is not eligible for non-qualified like kind exchange. In this example, we'll see that in his business, a taxpayer owned several laptop computers and decided to exchange them with another business owner for a new desk and filing cabinets. Determine whether the taxpayer's transaction qualify as a like kind exchange. Now, laptop computers, office furnitures are both personal property. The like kind exchange rules no longer apply to personal property. It only applies to real property. Therefore, an exchange would not qualify for a non-recognition treatment available under the like kind exchange. Now, what are the few things that we need to keep in mind when we are doing the like kind exchange? So these are the few things that you have to keep in mind. That the like kind exchange is only on real or investment property. Okay. The second thing that you have to remember that a like kind exchange you will first have to identify the property within 45 days of the exchange, and you will have to receive the property within 180 days after the taxpayer transfers the property in the like-kind exchange or the due date of your income tax return, whichever is earlier. Okay. So within the first 45 days, you have to identify which property you're getting, and the earlier of your filing date of 180 days from the transfer, you will have to receive the property. So there is a timing requirement. Third, gains and losses, as I mentioned here, both gain and losses will be deferred. Fourth, very important point, that you will have to know the basis of the property that are exchanged, because now we are deferring the gains and the losses. So you will have to know how do you calculate the basis of the property that you have received. Look carefully to if they are asking to determine the realized gain or recognized gain. So remember, I told you that there are two terminologies which will be repeated intensively under this section, is realization of gain and recognition of gain. Realization event is when there is a change in the ownership, when there is a economic transfer that is happening. But a recognition of the gain or the loss will depend upon the circumstances. So what circumstances are those? When there is boot involved. Okay. Now what is boot? Boot can be in the form of cash. Boot can be in the form of property that you are receiving, which is not a like-kind exchange property. Boot can be in the form of you being relieved of your debt. I'll repeat myself once again. There could be a possibility that you may have to recognize gain. That would depend if there is boot involved in the transaction. What is boot? Boot can be cash that you're receiving in the exchange apart from the property. Boot can be any other property which is not a like-kind exchange property. Boot can be a relief of a debt that you had associated with the property that you exchanged. Okay. So these are the few things that you have to keep in mind when you are learning the like-kind exchange provision. Now remember that it is very important for us to determine the property that we are receiving, the basis of the property, because that is going to help us understand how much will be the basis of the property and what is going to be my deferred gains or losses. Okay. So first, I will see what is the total benefits that I'm receiving, whether I actually have a gain or a loss in the transaction. Now, whatever the fair market of the property that I'm receiving in exchange, if I have gains, that defer gains, I'm going to minus that amount, and that will be my basis of the property. If I am receiving less than what I have given, then I have a loss. So here I have to defer the losses. So I'm going to add the deferred losses to the basis of my property. Remember, then when we did involuntary conversion, we deferred the gain, so we reduced the value of the property, right? Now, if you have to defer the losses, what will you do? You will reduce the basis of the property, or you will increase the basis of the property? You will increase the basis of the property, because higher the basis, in the future, when you sell the property, you will recognize less loss, like less gain. Okay. Now, few terminologies that you should be familiar with. I'm sure we already have done this during our graduations, but it doesn't hurt to do a refresher. Adjusted basis is your original cost minus your accumulated depreciation, and in certain circumstances, it could also be an appreciation. Amount realized is the fair market value of the new property that you're receiving plus the fair market value of the boot that you're receiving minus the fair market value of the boot that you are paying. Sometimes you may end up giving cash with the property. So in that situation, you are giving boot and not receiving boot. Okay. So amount realized is the property that you receive, the boot that you receive minus the boot that you give. What falls under the category of boot? What did I say? What is boot? I would have repeated it at least 3 times. Yes, cash is boot. What else is boot? Fair market value of the property that does not qualify for a like-kind exchange. And the debt that you be relieved of. Okay. Now let's say you have a debt and the other party also have a debt. Now you are assuming one debt and you are giving off your debt. In that case, the net liability that is being assumed by the partner, like the person who is exchanging, that will be your boot. So if you had a mortgage of $3,000 and that person is assuming $3,000 and giving your property which has a mortgage of $1,000, in this case, what is the net liability that you've been relieved of? You gave a property which had a mortgage of 3,000. He gave you a property which had a mortgage of 1,000. So what is the net liability that is being relieved of in this transaction? It is $2,000. So that is your net liability assumed. So that is your boot. Okay. There can be boot received and boot paid. So not necessary that you will always be receiving cash or someone else will be receiving, taking care of your liabilities, or someone else is going to give you a property which is not a like-kind exchange. It can be a vice versa situation as well. All right. What did we understand so far in the like-kind exchange? First, like-kind exchange is only on the real property. Second, that you have to identify the property within 45 days and receive the property in the earlier of your filing date of 180 days. And then both gains and losses are deferred in this transaction. All right. Let's look at this example here. A taxpayer owns real estate held for investment that is worth $40,000 and has an adjusted basis of $25,000. The taxpayer exchanges this property for other real estate held for investment, which is worth $35,000 and cash of $5,000. Okay. Now, first of all, you tell me whether this transaction is going to qualify for a like-kind transaction or not. The person is giving real estate and is getting a property in exchange. So it does qualify for a like-kind exchange. Now, the second thing that we are going to see is how much is our gain that we have realized. Remember, there is a realization event because the ownership of property is changing. You're owning a property which was owned by someone else now, and you're giving off your property which you owned. So there is an economic exchange. All right. So let's see how much did I give and how much did I receive. My basis, we'll always take the adjusted basis. Whenever we are giving the property, we will focus on the adjusted basis of the property. So we gave a property which was worth $25,000. What did we get in return? We got a real property which is for $35,000, and we also received boot that is cash, which is $5,000. So what did we get in total? $40,000. If I look at the transaction, I gave a property which had a tax basis to me for $25,000. I received boot and property which is worth $40,000. So how much gain have I realized in this transaction? $15,000, right? So I have realized a gain of $15,000. Now, how much of the gain will I be able to defer? See, you are receiving $5,000 in cash. So whenever there is boot involved, you will have to recognize certain gain. Okay. So whenever there is boot involved, gain is the lesser of the realized gain or the boot received. So gain here is $15,000 and the boot received here is $5,000. So which is lesser? $15,000 or $10,000? Obviously, the boot received is lesser, which is $5,000. So I will realize a gain of $5,000. I will recognize a gain of $5,000 and I will pay taxes on it. And then the remaining $10,000 I will defer. And how am I going to defer it? By adjusting the basis of the property that I have received. So I've received a property which has a basis of $35,000. What will I do to the basis of the property? I'm going to reduce the basis of the property by $10,000, which is the gain that I want to defer. And now the basis of my new property is going to be $25,000. Okay. We have many examples on this concept. So once we do all the example, it will become very clear. Let's see example number 13. A taxpayer exchanges a warehouse used solely for business purposes for another warehouse to be used in business. The warehouse original cost is $35,000, is currently worth $20,000. The taxpayer has taken $18,000 of depreciation on the old warehouse. Assume that the warehouse the taxpayer wants in exchange is worth $20,000. First of all, does this qualify for a like-kind exchange? He's getting a warehouse for a warehouse. So it does qualify for a like-kind exchange. Now, what is my adjusted basis of the warehouse that I want to exchange? I bought the warehouse for $35,000. I have taken a accumulated depreciation of $18,000. So my adjusted basis in the warehouse is $17,000. What is the value of the warehouse that I'm getting in exchange? The value of the warehouse that I'm getting in exchange is $20,000. So what is my realized gain here? My realized gain here is $3,000. Okay. Do I recognize any gain in this transaction? Do I need to recognize any gain here? Is there any boot involved? Is there any cash involved? Is there any other property involved? Is there any liability involved? No, right? So when there is no boot involved, I will not recognize any gain. So now if I have to defer this $3,000, how am I going to defer it? I'm going to adjust the basis of the new property. So the new property basis is $20,000. What will I do to this $20,000? I'm going to reduce the basis by $3,000, which is my deferred gain. And I'm going to book the basis of my new property as $17,000. So what is happening here? You are reducing the basis of the new property. So now let's say if you sell the warehouse after 6 months for $19,000, How much gain will you pick up in that transaction? You will pick up a gain of $2,000, right? So lower basis, higher gains in the future. Let's look at example number 40. The warehouse cost is 35. Current worth we will ignore. Wants to exchange for a warehouse which is worth $20,000, and the taxpayer has taken a depreciation of $12,000. So first of all, does this transaction qualify for a like-kind exchange? The answer to that is yes. What is my adjusted basis in the property that I want to exchange? I bought it for 35. I have taken a depreciation of 12,000. So my adjusted basis is 23,000. What is the property that I'm receiving in exchange? The value of the property is 20K. What is my realized gain or loss in this transaction? I have a $3,000 of loss. Remember, in like-kind exchange, we will also defer the losses. So now in order for me to defer the losses, how am I going to do it? I am going to adjust the basis of the property that I have received. So the fair market value of the property that I have received is $20,000. What am I going to do with the $3,000 of deferred gain? Am I going to step up the property or step down the property? I'm going to step up the property by the deferred losses of $3,000, and I'm going to book the property for $23,000. Now, let's say in future, if I sell this property for $21,000, what will be my gain recognition or loss recognition? I will recognize a loss of $2,000. Okay. Now, let's look at the example number 415, where we have boot involved. So I have a warehouse of 35,000. I've taken a depreciation of 18,000. Current value of the warehouse I will ignore. The taxpayer gets a new warehouse, which is worth 16,500, and also he gets $3,500 in cash. Okay. So first of all, does this transaction qualify for a like-kind transaction? The answer to that is yes. Now, what is the adjusted basis of our warehouse? The adjusted basis of our warehouse is $17,000. $35,000 is the cost minus $18,000 of depreciation. What is the total value that we are receiving in exchange? We are receiving a warehouse which is worth 16,500, and we are receiving for $3,500 in cash. Okay. So we are receiving $20,000 in total. What is our realized gain here? Our realized gain here is $3,000. So we said that whenever there is boot involved, that means whenever we are receiving boot, we will have to recognize gain, which is the lesser of the realized gain or the boot received. Okay. So here cash received is 3,500 and our gain realized is 3,000. So which is lesser? The boot received or the realized gain? So obviously the realized gain of $3,000 is lesser. So we will pick this up as income and pay taxes on it. Okay. Do we have any gain left that needs to be deferred? So what is going to be my basis of the new property that I have received? The basis of my new property is going to be 16,500. Okay. Let's look at the next example. Here, everything else is same. only the taxpayer is now getting a warehouse which is worth 17,500 and the boot here is 2,500. So all the calculation will be same. Here your realized gain is 3,000 and the boot that you have received is 2,500. So which is lesser? Your realized gain or the boot received? So here if you see the boot received is lesser. So to the extent of the boot received, we are going to recognize the gain and pay taxes on it. So of my $3,000 of gain, 2,500 I've already recognized and paid taxes. How much of the gain is left that needs to be deferred? So what am I going to do with that 500? My basis of this property is 17,500. I will minus the $500 and my basis in the new property is going to be $17,000. Okay. In this example, there is a there we are giving cash here. So we have a warehouse which is worth $35,000. There's a depreciation which we have taken, which is $18,000. The warehouse current value we will ignore. The new warehouse that we want is $22,000. So the taxpayer gives $2,000 in cash. So here we are giving $2,000 cash. We are not receiving. So what is the net book value of our warehouse? It is $17,000. And how much cash are we giving to the other property, other person? We are giving the other person $2,000 of cash. So what is the net value that we are giving? We are giving a warehouse which is worth 70 plus we are giving cash which is 2,000. So we are giving a value of net 19,000. What are we receiving in exchange? We are receiving in exchange a warehouse which is worth $22,000. So what is our realized gain here? The realized gain here is $3,000. What are you going to do with that realized gain? See here, there is no boot involved. You're not the one who's getting the cash. You're the one who's giving the cash. Okay. So you are not receiving the cash. You are at the giving end. So there will be no recognition of gain because you're not receiving the boot. So in this case, what's going to happen? You're going to defer that $3,000 gain and you're going to reduce the property basis that you're receiving from $22,000 to $19,000. Okay. Now this example, we have liability associated. So there's a warehouse which costs $35,000. You have taken a depreciation of $18,000. So that means it is worth 70. The old warehouse is now currently worth 20. We'll ignore this. And has $5,000 of secured debt attached, which the other party will assume. So you have a $5,000 of debt associated with the warehouse. The new warehouse that the taxpayer wants in exchange is worth $18,000 and has $3,000 of secured debt, which the taxpayer assumes to assume. So you are getting relieved of a debt which is $5,000 and you are taking a debt which is $3,000. So are you getting a net benefit out of the debt that you are assuming? You are getting benefited, right? Because you are giving a debt of 5 and you're assuming a debt of only 10. So your net debt that you are getting benefit for is $2,000. So now this $2,000 is your boot in this transaction. Okay. Now let's say what is the total benefit that I'm getting? I am giving a warehouse which is worth $17,000 and I am getting a warehouse which is worth $18,000 plus I am getting relieved of a debt which is for $2,000. So what is my net benefit here? My net benefit that I'm receiving is $20,000. So my realized gain in this transaction is $3,000. But you see, the net relief of debt is a boot. So whenever there is boot involved, what happens? You will have to recognize gain, which is the lesser of the boot received or the realized gain. So here the net relief is $2,000. This is our boot received. And our realized gain is $3,000. So which is lesser here? $2,000 is lesser here, right? So of the $3,000 of realized gain, $2,000 we are going to recognize and pay taxes on it. 1,000 we are going to defer. And how we are going to defer that? We have a property which is worth 80. We are going to reduce it by $1,000. And our property basis in the new property is going to be $17,000. I'll pause here. We will do the installment sale and the other transaction in the next class. We will also do some questions before we move on to the disposition of trade and use property. Okay. So I'll pause here and I'll see if you guys have any questions on the content that we have covered today. Did you find the topic comparatively easy? Were you able to understand? That's great. Thank you so much. I know by now you're already brain dead because you're studying since 6:30 morning. I guess I will share those presentations once I'm done explaining the entire topic. So that may come in a week or two. I'm still working on more examples. Any admin related question, whether you have to buy the TCP book, online access and all that, I would request to reach out to the admin. There are few new topics in the TCP, so it is highly recommended that you get a new TCP book. People, no questions from today's class? Everything was crystal clear? Okay, Meera has a question. Question on non-qualified use provision. Prorate gains will be excluded, right? And the remaining will be taxable. So you are prorating the gain that is used for non-qualified purposes. So the gain that you're calculating will be the one that will be taxable and the remaining will be non-taxable. So let's say that if my, the non-usage of the property was 3 years for the ownership that I had for 4 years, then here your disqualified use of the property is 75%. So 75% of the gain will be taxable and only 25% will be available for exclusion. No questions, people? Can we end the session then? Okay, what question Harshad has? If property sale December 2022, married filing jointly 500 above and purchase same as March 2020 current year, the tax treatment is the same because the $500,000 limit has not changed for many years now. It was the same when I gave my exam also. Any other question, people? All right, in that case, I give you back 5 minutes. Thank you so much, everyone, for actively participating and putting your responses in the chat window. So we will have, I will send out a revised schedule for you. We will start our class from 9 p.m. from next week onwards, all right? I wish you a great Sunday, and let's speak again on Saturday, 9 a.m. Bye, everyone.